Welcome to Market Signals. I'm Christian Kerr, head of macro strategy at LPL, and I'll be your host this week. We're coming off a rough week for the bond market, which had its worst weekly performance in over a year. Yields on the long end are moving higher globally, with particularly sharp increases in markets like the UK and Japan. In the US, we also notably had the first 30-year auction price above 5% in over 18 years. So to help us break it down, I'm joined by my colleague, Lawrence Gillum, LPL's chief fixed income strategist. Lawrence, great to have you on.
Yeah, great to be here. Like you said, it's been a pretty volatile week over the past week. So
should be plenty to talk about.
Absolutely.
Let's start at a high level. From your perspective, what's really driving this broad-based move higher in back-end yields, and what is the risk that this is the start of a larger trend in yields?
Yeah, it's really interesting. So last week, if you look at the economic data, we got some inflation data here in the U.S. that was, as expected, came in kind of on the high side. Markets didn't really move around too much here in the U.S. So I don't know that what we're seeing here in the U.S. is simply a byproduct of higher inflation expectations. I think this really is global in nature. We saw a really big sell-off in global bond markets on Friday. As you mentioned, Japan and UK gilts were kind of leading the move higher in yields. UK gilts are at the highest levels they've been since 1998, and the long end of the JGB curves are the longest, or the highest ever. It's one of these things where I think that bond markets are global by design, and I think when we start to see this kind of sell off in one market, it tends to spill over into another market. If you think about the cross ownership of Treasury securities and JGBs and other government bond securities, these are all global in nature. So when UK gilts sell off as much as they did, they're the second biggest owner of Treasury securities. That's going to have a negative impact on the Treasury market as well. So I really do think that this is just kind of a broader concern about duration, and there is some inflation component in there for sure, and a repricing of monetary policy expectations, which is kind of pushing out the long end as well. So it's really been this perfect storm of kind of higher inflation, more probability of synchronized rate hikes versus cuts, and then you have the issues in the UK about some political dysfunction as well. So it was not a good week last weekend when all three of those things came together to push yields higher.
Yeah, let's dive a little deeper into the foreign side. So we've talked about Japan, the UK. I think long end gilts, so 30-year gilts, highest level since the late 90s. So can you speak a little bit more about what's going on in these markets in particular? Like, I know the UK, it's very political. There's a political aspect to it, but I know there's a lot of sensitivity. Because the last time we were at these types of levels and yields, you had the so-called Liz Truss moment. Walk us through a little bit more in detail what's going on here in Japan and the UK.
Yeah, for sure. So what's interesting, the Liz Truss moment came when the 30-year gilt hit 5%. I think we're closer to 570 right now. So we've moved really far past that Liz Truss moment, and there is that political dysfunction going on in the UK. There's some questions about Keir Starmer's future. There's some challengers that have stepped up to challenge his seat, and I think the concern there is that and I kind of use this loosely, but I think the market is looking at Starmer as more of a fiscal conservative versus the potential challenger, and there'd be an expectation of additional kind of fiscal spend in the UK, higher gilt issuance, and markets really push back on that. I think fiscal conservative is not something that we can really use around the world these days, because it's not really true, but I guess it's all relative. But I think there is broader concern within the UK that if Starmer is replaced, you'll have a new prime minister and come in and increase fiscal spend, and that's going to add to budget deficits and gilt issuance. In the Japanese markets, we had some PPI data come out last Thursday, came in really, really hot, month over month and year over year, and I think that kind of really is forcing markets are really forcing the hand of the Bank of Japan to raise rates, and I think that they've been hesitant to do so, and I think the markets are kind of pushing towards further rate hikes in 2026. We have about 2 hikes priced in for the Bank of Japan this year, and As long as these inflationary dynamics continue to worsen in Japan, I think that's going to really force the markets to push the Bank of Japan to these rate hikes.
Okay, so is it safe to say or fair to say that the market thinks that the BOJ is a little behind the curve?
Yeah, absolutely. I think that's exactly the point, and that's why I think that the market is really going to force the BOJ to hike rates here. What's interesting though is that markets aren't pricing in a full rate hike for the June meeting, but to the July meeting. So there's still room, I think, to kind of force a June hike.
Okay, something to watch out for. I did want to circle back on the UK. I mean, listen, I understand kind of the fiscal fears there, but I also think it's lost a little bit. But policy is a lot stricter than it was during the Liz Truss era, or more so, I guess. So I think that there's a bit of the market here that I think thinks it's more about politics, but you can just say we would naturally be higher by by at least 100 basis points, just because policy is so much higher than it was. Is that a fair assessment, or do you think it's just purely about the fiscal fears?
No, I mean, I think it is fair, and I think what we're seeing in terms of things like term premia, these are increasing globally as well, as those concerns broaden out about issuance and higher inflation volatility. We've talked about term premia a lot here in the U.S., and that's kind of started to normalize a little bit. I think it's still a little bit too low given current dynamics, but we're seeing that globally as well. And frankly, I think it's healthy to have an increased term premia globally. Investors aren't getting compensated right now to own a lot of duration, a lot of longer maturity securities. And until there is that additional compensation there, that's not going to entice investors to buy the back end of curves. And that's why I think our view is that we'll probably continue to see some steepening in some of these markets. If rates fall down or fall from current levels, I think it'll be primarily on the front end of curves and not towards the back end of curves.
Okay. Well, I mean, you're making a case for at least back end yields. The path of least resistance in the near term seems to be somewhat higher. So when you step back and look at all this, I think the obvious question becomes what would need to happen for yields to stabilize from here?
I think the first thing is some clarity around the Iran conflict. If oil prices stay around current levels or even fall a little bit, I think you're going to get some additional clarity as it relates to the inflationary story. I think what's still going to be a big issue on a go-forward basis, and we wrote about this in our outlook, I think last year, is that just issuance is going to be a problem for a lot of global governments because of just the deficits that these countries continue to run. So I think it's really going to come down to what happens with the Iran conflict. Will we see some relief at the gas pumps or not? And then I think that there's still the concerns about central banks that are kind of put in a position where I think the bar for rate cuts, I think, is starting to get a lot higher than it was a couple of weeks ago.
Yeah, for sure. I mean, I think it's difficult. If you look at gasoline prices, we're getting really close to the 2022 highs coming in the driving season. But I think that's a great point. If you look at 10-year yields versus December 2026 Brent crude or whatever, they're trading almost tick for tick. You look at gasoline futures versus inflation swaps, same type of things. That really is kind of the crux of the reason for the inflation scare spilling over into bonds. But it really is kind of all about oil. So it sounds to me like really another way to kind of answer this question is like you kind of need some stability in the oil market to sell off, which would mean kind of some sort of resolution with Iran and the opening of Strait of Hormuz, right?
Yeah, absolutely. I mean, that's certainly been weighing on near-term inflation expectations, market implied inflation expectations. But what's interesting is the back end of the sell-off here, at least here in the U.S. The 10-year Treasury yield since the Iran conflict started. The 10-year Treasury yield's higher by about 66 basis points. About 40 basis points of that came from higher TIPS yields, higher real yields, a higher repricing of central bank policy rate expectations, whereas the difference is only 24, 25 basis points in inflation expectations. So I do think that the longer this plays out, that you could see these 10-year inflation expectations move higher too, which would put, again, or upward pressure on the 10-year Treasury yield. So it's been a big move already. I don't know that we're out of the woods, That's one of the reasons why we're not big fans of owning a lot of duration in this market, or frankly anywhere in the globe. So outside of munis, I think munis are a different story, but within government bond markets, there's not a lot of value to own a lot of duration right now, because I think that the path of least of resistance is still higher for longer maturity securities.
Okay, fair enough. But I got to ask you, at what level, I don't know, in say 10-year yields, do you start thinking about being a buyer?
Yeah, it's an evolving question, or evolving answer. I think we've talked about 4.75, 5% on the 10-year as an area that would look pretty attractive. Certainly, a lot of that's going to depend on what happens with the Iran conflict. If we continue to see this price shock, we've talked about this, in our stack meetings, that if there's an oil shock, it does take a while to articulate into the real economy, but then you start to see some real economic deterioration, and I think that would be an actual head or a tailwind for yields if that were the case. If we were to see a big increase in the unemployment rates, if we were going to see some steep declines in economic activity, I think that would allow the 10-year Treasury yield to fall. That takes time, though. So I think, but if we did see a 4.75, 5% 10-year yield, I think that would be a pretty attractive place to start to re-engage with duration.
Yeah, and look, when Bessent came to be the Treasury Secretary, he basically said he sees his number one job as being America's primary bond salesperson, right? And he's talked about 5% kind of being his North Star. So I think you got to take him at his word that you start getting to 5%, you're going to see, 5%-ish, maybe, a little bit above there, but you're probably going to see policy that tries to get yields down, right? Given that that is kind of a key tenet of his policy, at least he's stated that. Right. I mean, I'm a little bit of two minds because, if you look at kind of where bonds have been trading, you have this very kind of tight, compressed range. To start the year, you look at things like realized volatility. You look at things like, average true range. We were at levels we really hadn't seen before, or hadn't seen in a long time, which tends to be, you're going to get meaner version of higher volatility. So it's tough because you've got kind of that aspect. You've got a market that's getting somewhat crowded. You've got CTAs starting to get fairly short bonds. And you see this compressed chart. I could see, if you ignore everything, you get a pretty big move higher in yields. But then you've got this stated policy from the administration that says we don't want to see 10s get above 5. So you kind of have that competing dynamic to analyze here. And ultimately, I think, the administration to do what it needs to do to put a ceiling in yield somewhere around 5, right? Is that how you're thinking about it?
It is, but then you think about what could the administration do to bring down long-term Treasury yields, right? So I mean, I think they're kind of limited in terms of changing their issuance trends. They're already really relying on T-bills to fund these deficits. They're around 22% of issuance is in T-bills. The Treasury Borrowing Advisory Committee has said 20% should be the max there, so they're a little bit above what their consultants are telling you. I think. What's interesting is that Bessent, before he took over, he criticized the previous administration's inability to extend the weighted average maturity of debt. It doesn't look like he's going to do that, and it wouldn't make sense from a financial perspective to do that either. So maybe they could, change the issuance a little bit and rely more on bills to kind of reduce the amount of supply out there on the long end of curves. But outside of a kind of a new Treasury Fed pact, I think that there's not a lot of things that I can think of that would help bring down Treasury yields. They've talked about things like changing regulatory rules, and they've done some of that already. But we haven't seen any sort of a lot more. We haven't seen a lot more demand come to market because of some of these regulatory changes just yet.
Well, something like yield curve control.
Those are the three. Those are the three words you can't utter in the fixed income markets. Right. It scares me, but no, I think that's probably the natural solution to higher yields, and they can declare a crisis and say that the debt's too expensive. And what's interesting is I think it was 2 weeks ago, Gunlock came out and said that they're going to replace all their high coupon debt with low coupon debt. I don't think they can do that. I think that would result in a technical default. But outside of things like that, yield curve control is probably a break glass type of policy where They could say that this is a crisis, and that's where your Treasury Fed accord would take place, and you have the Fed, start buying a lot more longer maturity securities and kind of keep interest rates low.
Yeah. Okay. Let's bring in your favorite topic here, equities. So let's bring them into the conversation a bit. Typically, we do a lot of work with Vanda Analytics. They've done some great work where they've found that when you get basically about a 30 basis point move in bonds over like a 3-month period, that tends to start to weigh on equities and make them get nervous. Was what we saw on Friday. You think that could be kind of traced back to what's going on in yields, or when does this start to matter to the equity market, do you think?
Yeah, for sure. I mean, definitely not my wheelhouse, but I do think that the 30-year touching 5% and staying above 5% has a big impact on equities, right? I mean, that's your valuation as part of your valuation component. So I think it's definitely the volatility within the rates market, and then levels that have increased pretty significantly as well. You have a lot of these longer duration equity equities out there that are could potentially get negatively impacted by higher bond yields. But we're down again today on the S&P 500 about 56 basis points, so not a tremendous sell-off, but higher yields are kind of pointing towards lower equity prices currently, because of just what we've seen recently in the rates market.
Okay. How about private credit? Some more negative headlines there last week. How is that space kind of playing into all this in terms of yields starting to move higher?
Yeah, it's a good question. So we haven't really seen that transmission into the public markets yet from the private equity space. I think that we've talked about this, that if you started to see some real stressed private credit issuers out there, I think you would see some, or managers out there. I think you would see some of these managers that would necessarily need to provide liquidity and sell some of their less or more liquid stuff, their bank loan securities in particular, or their high yield bonds if they own some things that are in the public markets that would allow them to come up with some liquidity pretty quickly. The spreads for the high yield bond market, the investment grade bond market, the bank loan market, they continue to move lower of late. So we haven't really seen a lot of concern or a lot of that crossover from private to public markets. So I think it's still, you don't want to use the word contained after the global financial crisis, but I do think that it's probably still contained at this point.
Okay. Let's shift gears a little bit here. We got some big changes happening at the Federal Reserve. We got Kevin Warsh. I don't think he's technically started yet as the chairman of the Fed, but he was approved last week, so will be coming in shortly as the new Fed chair. How's that going to affect short-term rates, one, and then two? If you look historically, whenever you've had a new Fed chair, they tend to get tested pretty early. Going back to Greenspan, right after we started, he had the 1987 crash. So it tends to be a trend that the markets test new Fed chairs. Do you think this could be part of that test? Because he is coming into an environment that is a lot different than it was a few months ago. We were talking about rate cuts to where now markets are actually pricing in a full hike by Q1 of next year. So how do you view a Warsh Fed here?
Yeah, it is interesting. I mean, so you do get that market tends to test new Fed chairs because of differences in communication styles and differences in just kind of philosophies. So, I mean, we could see, I guess, part of this sell-off in the bond market could be associated with that. But like I said, there's so many different dynamics that are taking place right now globally within the bond market that are pushing yields higher. But this wouldn't surprise me if this were one of the issues here in the U.S. I think what's going to be challenging for Kevin Warsh is that it's a committee structure. To get rates lower, he needs 7 yeses, and even to change the structure or the size of the balance sheet, he needs to get 7 yeses. So I think that it's going to be a challenge for him to come into this environment where a lot of the colleagues on that committee have started moving towards no cuts this year, or I think some have even come out and said, they wouldn't be surprised to see their next move as a hike. I still think the bar for a rate hike is still pretty high at this point, but they're certainly discussing the potential for rate hikes. So you have to wonder. I mean, how much time is Trump going to give Warsh to actually potentially bring down rates in there before we start to get some angry tweets? But I think right now he's really limited in his ability to do much unilaterally because he is going to need that consensus. There's 12 voting members on the committee. You need 7 to 5, and I think he's going to have a tough time, especially now that Myron is off the board. Christopher Waller is thought of as a dove. He was in the race to replace Powell, but he's since kind of moderated his views a little bit. So really, he might be on an island in terms of a lot lower rate or a lot more rate cuts than the rest of the committee, and I think that's just going to make his job even more challenging.
Yeah, and I think one of the more interesting dynamics here is that you're going to have a former Fed chair sitting on the committee as well, at least for now, right? Does that almost make like a shadow chair type of framework? It's going to be an interesting one because I don't think we've ever seen that before.
There was one other time when Eccles was stayed over so Eccles was, I guess, largely considered the first chair of the Federal Reserve post banking regulations in the 30s. It's actually the name of the building as well. But it only happened one other time. Most other Fed chairs, when their term expires, they do step off the committee. Chair Powell has said he'll stick around until all the legal challenges are behind him. So it's kind of left an almost a kind of open question as to how long that'll be. He's actually, to your point earlier, Warsh hasn't been sworn in yet. He'll be sworn in at the White House, actually, I think next week, perhaps. First Fed chair to be sworn in at the White House since Greenspan. So I think that's symbolic in a certain way, given what Warsh has talked about in terms of regime change. But in the meantime, Powell was voted pro tempore, so is kind of still the head of the Fed for now. I think it's going to cast a pretty sizable shadow over Warsh. I mean, I think what we've seen over the past few years is that Powell has done a really good job in consensus building, and I think a lot of people kind of still trust his judgment. And you have the new guy coming in and talking about regime change, so it's going to be an interesting dynamic. And we've talked about that. I think the job of the federal of the chair of the Federal Reserve is always a difficult one because you're almost damned if you do, damned if you don't, because given their dual mandate. But you also have these almost these soap opera dynamics going on right now within the Fed that I think it's going to make markets a bit more volatile than they otherwise need be. I mean, if what can you imagine what the markets would do if Warsh says something and Powell says something completely different the next day? I mean, what's that going to do for market volatility?
Yeah, I think it's going to make it go up, right? Okay, let's one final question here. Just because we've talked about a lot of things. We've got a pretty interesting week coming up. We've got the Fed minutes. We've got a big auction in Japan. What are some of the key data points you're watching here in the near term to give you some visibility into where the next path is for rates here?
Yeah, it's the two things that you mentioned. We don't have a lot of top tier economic data this week, so we don't have to worry about jobs or CPI like we have over the last couple of weeks. So we don't have any big treasury auctions here in the U.S. either. So it's really going to be. Every time I say this, I jinx myself, but I do think it's going to be a relatively quiet week this week. Just because we don't have a lot of top tier economic data in the U.S. But given what we've talked about, given the spillovers that we're seeing in other markets, just because we don't have a lot of top tier economic data here doesn't mean that other markets are going to potentially be a bit more volatile than usual, and that could flow into our markets as well. So I think it's really a lot of just non-U.S. data that's kind of more important than U.S. data this week.
Okay. Well, I would say quiet week, geopolitics withstanding, right?
Yeah, absolutely. That's always top of mind.
Always a wild card right now. All right, I think we can wrap things up there. Great insights as always, Lawrence. Really appreciate you taking the time to walk us through it today. Thanks everyone for listening. Please join us next week for another edition of Market Signals. Until then, bye for now.